And if you're ready to project your deal, well, you guessed it. The Projections tab is where you'll do that. This is where the assumptions you entered in the sidebar come to life. To start, you'll need to establish your base year, the foundation for your future projected years. The base year should reflect what the company's financials will look like under your ownership post acquisition. It's typically based on the most recent year of the historical financials, adjusted to reflect how the business will operate under your ownership. When you first land on this tab, you'll have the option to import the most recent year from the Historicals tab to save you time. You can also do this anytime by clicking this icon here. Since we've already populated the numbers, I'll just hit cancel. Everything from your historicals, including any itemized rows, will carry over automatically. Just make sure to review the base year and remove any seller-specific expenses that might have carried over from what was entered in the Historicals tab. So specifically, you'll want to make sure that certain expenses such as the seller's add-backs, their depreciation and amortization, or their taxes isn't included in your base year, since those won't apply to you post-close. For example, here's a depreciation line item that carried over from the historicals, which we'll go ahead and delete. Once you establish your base year, from there, you'll simply select the number of years you'd like to project, and then apply your growth rates, which you can do so in one of two ways from this drop-down menu. The CAGR mode allows you to apply a single compounding annual growth rate, which will carry forward to all years, and the amounts in the individual years can be edited, and then reverted if you'd like to go back to the formula. The per year mode locks the amount rows and makes the growth rate percentages editable. So this makes it easier to model scenarios like a J-curve, where performance dips or stays flat during the transition period and in earlier years, then accelerates as the growth investments begin to pay off. As you'll notice, the layout of the projections is very similar to the Historicals tab, but with a few notable exceptions. The Depreciation and Amortization row is broken out into 3 subrows: D&A for goodwill, D&A for deal expenses, and D&A for growth CapEx. All 3 are non-cash expenses. They don't impact cash flow directly, but they create a tax shield by lowering taxable income and reducing the amount of taxes you pay. Let's quickly walk through what each one means. D&A for goodwill represents the annual amortization of the goodwill created when you buy the business. In most small business acquisitions, the deal is structured as an asset purchase, meaning you're buying the company's individual assets rather than its stock. When that happens, the total purchase price gets divided between tangible assets, like inventory, equipment, or vehicles, and intangible assets, things like customer contracts, trade names, non-compete agreements, or proprietary processes or software. Anything left over after assigning fair value to the tangible assets is recorded as goodwill, which essentially represents the value of the business as a whole. By default, the model assumes the business is asset light, meaning most of the purchase price is allocated to goodwill and other intangibles rather than hard assets. Under Section 197 of the IRS tax code, goodwill is amortized evenly over 15 years. The model simplifies this by taking the purchase price, dividing it by 15 years, and automatically applying a straight line schedule across that time period. If your deal is structured as a stock purchase instead, where you're buying the company's shares rather than its assets, the tax basis of the assets doesn't reset. That means there's no new goodwill amortization, since the seller's existing D&A schedule carries forward with the business under your ownership. In that case, or the case of an asset purchase where the business has a significant amount of hard assets, You can override any of these numbers to match the DNA schedule specific to your deal structure. DNA for deal expenses captures the amortization of one-time transaction costs, things like legal, accounting, diligence, or the fees associated with equality of earnings. These are also typically capitalized and amortized over 15 years. That said, some buyers expense all deal costs immediately in the year of the acquisition. If that's your approach, this row is also fully overridable. You can shorten the schedule or take the full deduction in year one. And finally, DNA for growth CapEx appears only if you've entered one or more growth CapEx investments in the assumption panel. To have one, turn on this growth CapEx toggle, click Add Growth CapEx, and enter the details: the investment type, the amount, the year in which it takes place, and the depreciation schedule. The cash outlay shows up in the growth CapEx line within the unlevered free cash flow section, while the corresponding depreciation flows automatically into the DNA for growth CapEx row. The income taxes row uses the company tax rate entered in the assumptions panel. The model automatically multiplies that rate by your taxable income to calculate annual income taxes. If you have investors and your deal is structured as a pass-through business entity, either an LLC or an S corp, taxes flow through to the owners. That includes you, your investors, and if applicable, any seller who rolled over equity. In that case, the company itself doesn't pay corporate taxes. Instead, each owner pays taxes individually based on their share of the company's income taxes, which is determined by their common equity ownership percentage. Those investor level taxes are handled through tax distributions, which we'll cover in more detail in the ROI metrics tab. If your business is structured as a C Corp, those taxes are paid directly at the company level. There are no pass through distributions to investors. If your tax setup requires something more specific, for example, a blended federal and state rate or a custom tax schedule, this row is fully overridable. You can override the automatic calculation and enter your own amount directly. Those changes will flow through to all areas of the model where income taxes are factored in. Now, let's take a look at the line of credit section. When you toggle this on, it adds a new set of rows to the debt service section. You'll simply enter the interest rate, the total amount of the line of credit, the amount you intend to draw, and the drawdown year. The model automatically calculates the interest expense based on the beginning balance of each year, and you'll see that reflected in the interest row. Just like any other debt expense, this interest reduces taxable income and flows through to the net income calculation automatically. If you plan to pay down the line over time, you can enter repayments in the principal payment row. The beginning balance and ending balance rows update automatically each year based on your drawdown and repayment activity, giving you a clear view of how much credit remains outstanding. Finally, this debt service section also includes your senior debt and seller's note if you have one. Any extra payments or balloon payments that you've entered in the amortization tab will appear here automatically, so you can see how they flow through your projections. If you want to model a sale of the company in your projections, you can do that here in the company sales section. Once you toggle this on, just enter the year you plan to exit and your EBITDA exit multiple. The model takes your EBITDA in that year and multiplies it by the exit multiple you enter and automatically calculates the gross proceeds from the company sale, which you'll see here in the unlevered free cash flow section. From there, the model follows a standard exit waterfall. First, any outstanding debt balances are paid off. These include your senior debt, seller note, or line of credit, which you can view here under the total debt service section. If you expand that row, you'll see two sub-rows. The first shows your regular scheduled debt payments. The second reflects any debt that must be accelerated and paid off due to the company's sale. In this example, we've modeled a company sale at the end of year 10. Since the seller note has already been fully paid off and we're using an SBA 7A loan, which is typically a 10-year fully amortizing loan, there's no remaining debt to settle, which is why you see 0 in this cell. Once all debt has been repaid, the remaining proceeds flow into the distributable free cash flow section. If you have investors, their portion of the sale proceeds appears here. If any preferred dividends or principal repayments are still outstanding, the model automatically deducts those amounts first as part of the waterfall. Preferred dividends and principal repayments are part of a standard participating preferred structure for investors, which we'll cover in more detail in just a minute. Whatever remains after investors receive their share then flows down to the usable free cash flow line, which goes to the searcher. All of these sale-related calculations, from debt paydown to investor distributions, flow through to the ROI metrics tab, which we'll cover shortly. Let's circle back to the equity investor distribution section. If you have investors or a seller who's rolling over equity, you'll see their distributions appear here. Once you've entered your investor assumptions in the finance structure in equity terms sections, the model automatically calculates the company ownership split. Investors can receive either common equity only or preferred equity, which will also then convert over to common equity on a pro rata basis. If an investor group is classified as preferred equity, that's when the participating preferred structure takes in, and the model builds out a full investor waterfall automatically. Here's how a participating preferred structure works in terms of payout priority. Preferred dividends is first. It's the first senior claim, which represents the preferred equity investor's annual preferred return based on the preferred equity rate that you entered in the assumptions. That rate is applied to the outstanding balance of the invested capital that's classified as preferred equity. Principal repayments is next. It's the second senior claim. This represents the 1x liquidation preference that preferred equity investors receive. This means those investors give their original invested capital back before anyone else participates in profits. As this amount is paid down, the preferred dividend payments will naturally decrease as well, since they're calculated on the remaining balance. Profit distributions is next. Once both of these preferred layers are fully satisfied, payouts shift to profit distributions, which are based on each investor's common equity ownership percentage. And as mentioned earlier, if you've modeled the company sale, the sale proceeds follow the same hierarchy. Any unpaid preferred dividends or principal repayments are deducted first, and the remaining proceeds are then distributed according to common equity ownership. Now, let's take a look at how this all works within the model. The preferred dividends can be found here. Again, this is the first senior claim and represents that annual preferred return based on the outstanding balance of the invested capital classified as preferred equity. If you expand the preferred dividends row, you'll see two sub-rows. The current period is the amount that's paid out in any given year. The accrued amount reflects the unpaid portion of the preferred dividends and need to be paid in each year. Any unpaid amount is added to the ending balance of that year and becomes the starting balance for the next year. As preferred dividends accrue, they roll forward over time until fully repaid. To illustrate this with an example, let's say revenue dips in a given year, and there isn't enough distributable free cash flow to cover the full amount of the preferred dividends, or if you've delayed the start through. The unpaid portion is tracked in the accrued amount row and carried forward until it's paid in full. Below that, it's principal repayments. This is the second senior claim, where preferred equity investors receive back their original invested capital. The paid down row shows the cumulative amount repaid over time, while the starting and ending balance rows show what's remaining outstanding. Once both preferred layers have been cleared, we move down to profit distributions, where any remaining distributable free cash flow is paid out based on each investor group's common equity ownership. And finally, if you've modeled an exit, you'll see the investor proceeds from the company's sale here. This shows where the remaining proceeds flow after all debt and preferred obligations have been satisfied. Together, these rows give you a clear view of how every dollar of free cash flow is distributed to investors, starting from the senior claims at the top, down through common equity, and ultimately to the searcher's promote, which flows into the usable free cash flow line. These equity distribution numbers are broken out in greater detail on the ROI metrics tab. Let's go there now. You can access it by clicking the tab at the top or by clicking the blue full CAC table button here.